Welcome to the deep dive, where we really try to cut through all the noise and the jargon in corporate reports.
Yeah, there's a lot of it.
There really is. Financial reports, especially quarterly ones, can feel, well, overwhelming, right? Like finding a needle in a haystack made of numbers.
Exactly.
So we're here to give you that shortcut. We want to pull out the surprising facts, help you understand the real story behind KEI Industries Limited's latest numbers.
And we've looked at the official statements, the auditor reports, their investor presentation, all of it.
Right. Today, our mission is unpacking their Q1 FY26 results and some interesting things from their recent board meeting. KEI is a big name in cables and wires.
Definitely a key player. And we're boiling it down to what you really need to know, the aha moments without the headache.
Perfect. So let's start big picture. How did KEI actually do in Q1 FY26? How does it stack up against, say, last quarter and the same time last year?
Okay, so looking at those headline numbers year on year, it's a pretty robust performance.
Yeah.
Their revenue from operations saw a strong 25.44% increase. It jumped from about 2,065 crore in Q1 last year to 2,590 crore this Q1.
That's a solid jump year on year.
It is. But it's also worth noting there was an 11.13% decrease compared to the quarter just before Q4 FY25, which was at 2,915 crore.
Okay. So a definite annual improvement, but a bit of a dip from the immediately preceding quarter. How should we read that kind of Q-o-Q fluctuation alongside strong yearly growth?
It's a good question. Look, these quarterly dips, they happen. It's pretty common in business cycles, especially with companies involved in projects.
Timing can affect things.
Exactly. So the strong year-on-year growth, that's probably the more significant signal here. It points to positive underlying trends.
Okay, that makes sense. And what about the profit side? Tell us about their EBITDA, their operational profit, and the bottom line, the profit after tax, Pata.
Right, profitability. Their EBITDA, that's earnings before interest, taxes, depreciation, and amortization, basically a good measure of operational health. That saw a significant 28.06% year-on-year increase, climbed from 232 crore to 298 crore.
Nice increase there, too.
Yeah, and maybe even more telling, the EBITDA margin actually improved, went up to 11.49% from 11.25% year-on-year.
Ah, so they're getting more efficient.
Seems like it. Now, similar to revenue, there was a quarter-on-quarter decrease in EBITDA, down 12.05% from Q4's 338 crore.
Okay. That margin improvement, though, that's interesting. How do you manage that even when quarterly revenue dips slightly? Is it
Yeah.
product mix, maybe costs, internal stuff?
It's likely a mix of things. And, given what we're about to talk about with their sales breakdown, it does suggest maybe a shift towards higher value products.
Oh, okay.
Or maybe better cost control, procurement, something like that. Tells you they're not just growing the top line, they're growing more profitably.
Got it. And the final profit, petty.
PAT, yes. Profit after tax. This is the profit left for shareholders. Yeah. That showed really impressive 30.28% year-on-year growth.
Yeah.
Rose from 150 crore to 196 crore. And the PT margin also improved up to 7.56% from 7.28% year-on-year.
So improvement across the board on an annual basis.
Pretty much. Again, there was that QOQ dip, 13.62% down from 227 crore. And their basic EPS, earnings per share, also increased nicely year-on-year from 16.65 to 20.49.
Okay, let's unpack this a bit more then. To really get what's driving KEI, we need to look closer at, who is buying what and where. Segments, sales channels. Let's break it down.
Right. So the main engine, no surprise, is cables and wires. That segment brought in the vast majority, 2,477 crore in Q1.
Oh.
EPC projects added nearly 100 along crore, and stainless steel wire was about 52 crore.
And within cables and wires, what specific products are leading?
Good question. Looking at the product mix, LT cables, that's low tension, led the way with 1,037 crore. That house wire and winding wires together were 842 crore.
Right.
Then you have HT, high tension cables at 480 crore, and the higher value EHV, extra high voltage cables, at 126 crore. And just to round it out, EPC projects other than cable brought in 61 crore, and stainless steel wire was 51 crore.
That gives a clear picture of the product side.
Yeah.
Now, how are these getting to customers? You've got institutional sales and then their big dealer network, right? This is often where you see interesting shifts.
It certainly is. And here's something genuinely quite surprising. Institutional sales, And this includes exports, which is key. They grew by a huge 44.43% year-on-year in Q1.
44%. Wow.
Yeah, so that channel now makes up almost 45% of total sales, 44.77% to be exact. That's up significantly from about 39% last year.
Okay, so institutional is gaining share. What about domestic versus export within that?
Right, breaking that down, domestic institutional sales saw a solid 26.62% year-on-year increase, reaching 711 crore. And what's really noteworthy there is the jump in domestic institutional EHV cable sales.
High voltage stuff.
Exactly. That went from 79 crore to 116 crore. It signals strong demand, probably from utilities or big infra projects, for their high-end offerings.
And the export institutional sales, you flag that as key. Sounds like that could be a massive growth driver. What happened there?
You're absolutely right to focus on that. Export institutional sales saw a, well, frankly, dramatic increase, up 122.09% year-on-year.
Whoa, over 120%.
Yes. It's not just tapping new markets. It suggests maybe big tender wins internationally or just soaring global demand for their products. It's really paying off.
That's a potential game changer. What about the other side, the dealer and distribution network? Still the biggest channel.
It is still the largest channel, yes. Sales through their dealers increased by a healthy 22.21% year-on-year.
So good growth.
Definitely good growth. Its overall share dipped slightly to about 51% of total sales, but it remains absolutely crucial. And they have a really robust network backing that up, almost 2,100 active dealers as of the end of June.
Okay, so strong export growth pulling up institutional while the dealer network provides a solid growing base. Let's broaden out again. How did the other smaller segments, EPC and stainless steel wire, perform? And geographically, where's money coming from within India?
Okay, so EPC, the bit that's not cable related, that contributed about 2.4% to revenue. But interestingly, its export sales saw a big drop.
Oh.
Yeah, down from 58 crore last year to just 14 crore this Q1. Could be timing of projects, maybe completing some international contracts.
Could be. And stainless steel?
Stainless steel wire was about 2% of revenue. Its export sales were pretty stable, around 27 crore, so no big drama there.
Okay. And the map of India for KEI?
Right, the geographical split. North India is the biggest region for them, nearly 40% of revenue, 39.36%. Then comes the West at about 27%. South at 17%, and the East at roughly 17% as well.
Okay, good breakdown. Let's pivot now from sales to the company's financial foundation. Debt, cash. How healthy is KEI's balance sheet? Because that really underpins everything else, doesn't it?
It absolutely does. And, well, KEI is in an incredibly strong position financially. They're actually in what's called a net cash position.
Net cash, meaning?
Meaning they have more cash than debt.
Yeah.
So as of June 30th, their gross debt was about 203 crore. But their cash and bank balances were substantial, 400 and 699 crore.
Wow. Yep.
So you net that out, and they have a negative net debt of almost 1,500 crore, minus 9,496 crore to be precise.
So they could pay off all their debt and still have nearly 1,500 crore sitting in the bank?
Exactly. It's like, your bank account is so full it could easily pay off your mortgage, your car loan, everything, and still have a massive surplus left over. It's a very comfortable position.
That's undeniably strong, but sometimes you hear, for a company focused on growth, does holding that much cash raise questions? Like, could they be deploying it more aggressively, or does it signal something else?
That's a fair point, but I think here it's more about strategic flexibility. It's like a war chest. A big chunk of this cash comes from unutilized funds from a qualified institutional placement, a QIP they did last November. They raised $20,000 million, and as of June end, over $10,900 million of that was still sitting in bank deposits.
So it's relatively fresh capital earmarked for growth.
Exactly. It's not just sitting idle without a plan. It gives them immense firepower for projects, maybe opportunistic acquisitions if something comes up, or even just weathering any economic turbulence.
Right. Resilience.
Huge financial resilience and strategic options. And it shows in other ways, too. Their financial charges, like interest payments, as a percentage of sales dropped to just 0.56% from 0.69% last year. Excellent financial management.
That flexibility is key then. So what does this strong financial footing mean for their future plans, their growth, operations? I know they have some big projects cooking.
It means they can fund those big projects without really needing to borrow much more, if at all, which is great. For example, they just reviewed progress on their huge new cable manufacturing plant down in Sanand, near Ahmedabad in Gujarat.
Right, the Sanand facility.
Right. Yes. And they've got clear timelines. Phase 1, producing LTHT cables, is set to commission by September 2025, so quite soon.
Okay.
And then the really crucial EHV cable production, that higher voltage stuff, is planned to start by the first quarter of the fiscal year 2026-27. This financial strength basically ensures these expansions can happen smoothly.
That's a very clear expansion roadmap. What about their current workload? Do they have a good pipeline of orders already booked?
They absolutely do. Their pending order book is quite robust, standing at around 3,921 crore.
Nearly 4,000 crore.
Yeah, so that gives them pretty strong revenue visibility for the coming quarters, a
Yeah.
solid foundation.
Now, whenever we dissect numbers like these, it's always vital to ask about, how reliable are these numbers? What about the governance side? Audits, ownership?
Crucial point.
Yeah.
So the financials we've been talking about went through what's called a limited review by their statutory auditors, Pawan Shubham & Co.
Okay.
And the key thing is they issued an unmodified opinion. That's basically the best you can get from auditors.
Meaning no major issues found.
Exactly. It means they found no material misstatements. The numbers fairly reflect the company's position according to the accounting standards, in this case, Indian accounting standards, and AS. It builds that crucial investor confidence.
Good to know.
And just as a small aside, to give you a sense of the diligence involved, the board meeting where they actually approved these results, it lasted over 8 hours.
8 hours? Seriously?
Yeah, from 3.115 in the afternoon until 11:30 at night.
Wow, that's some dedication to getting the numbers right. Okay, and who actually owns this well-managed, cash-rich company? What's the ownership structure look like?
Right, the shareholding pattern as of June 30th, the promoters hold 35.02%.
Okay, about a third.
Then you have the institutions. Domestic institutional investors, DIIs, hold 25.63%, and foreign institutional investors, FIIs, hold a very similar amount, 26.59%.
Oh, interesting. Almost perfectly balanced between domestic and foreign institutions.
It is quite noteworthy, isn't it? And the public and other smaller shareholders hold the remaining 12.76%. That balance between DI and FIIs suggests, pretty broad confidence from different types of big investors. Could be a sign of long-term market belief in their prospects.
Okay, so wrapping this all up, what does this mean for you, the listener? Well, KEI Industries is clearly showing strong year-on-year growth, right? Profits, revenue.
Definitely.
Yeah.
Driven significantly by those impressive institutional sales, especially the jump in exports.
And they've got clear strategic plans for expansion with that big Sanan facility coming online soon.
Backed by a really, really healthy financial position, thanks in large part to that QIP cash they raised.
It paints a picture of a company executing well and building for the future.
Absolutely. The long-term vision seems clear, particularly that focus on the higher-value EHV cables out of Sanan, plus that strong order book providing near-term visibility. They seem to be positioning themselves quite strategically.
Which leads us nicely to a final thought for you to mull over. Given this huge investment in Sanan, especially gearing up for EHV cable production starting around early 2026, what competitive advantages could this give KEI in that high-voltage market? How might this big strategic expansion help them consolidate their position, especially thinking about the future, the big shifts happening in infrastructure, the push for renewables, smart grids? Where could this take them? Something to think about.